The US recently fixed the loopholes in the tariff laws. It barred companies like Temu and Shein from exploiting the de minimis exemption that's meant for individual tourists to bring home souvenirs after their trips. Chinese companies lost billions of dollars in market cap within seconds of the law being announced, while many experts deemed it to be a measure that was long overdue. In 2023, the United States bought more goods from Mexico than it did from China for the first time in 20 years. This is a big win for the North American regional economy, and it shows that the US has become less dependent on Chinese imports. Or that's what it seems like. During the same year, shipping volume from China to Mexico skyrocketed by 59.7%. The shipping route from China to Mexico is the fastest growing one in the world right now. But this is a bit suspicious. As you might expect, a lot of the goods arriving in Mexico get transported to the United States afterwards. There's one reason to take this elaborate route. Following the trade war, this has become a smart way to circumvent US sanctions. Mexico hasn't placed the same tariffs and import restrictions on Chinese goods, and China's tactics are ever evolving, as it's now also moving factories to Mexico and trying to find legal loopholes. This involves Mexico's free access to the US market with the USMCA agreement, as well as the de minimis import law. So let's take a deep dive into how China is trying to bypass Washington's trade restrictions and how the US is reacting to this. But before that, please be sure to hit the like button below. Any video relating to the CCP has a risk of being downvoted by CCP's 50-cent army to kill its reach in the algorithm. So your likes help us out a lot. China benefits a lot from the current global economy. It has the single biggest trade surplus in the world, reaching $823 billion in 2023. About a third of this comes from the United States, as it posted a trade deficit with China worth $279 billion in the same year. You can understand that it doesn't want to lose this precious market. But starting in 2018, it looked like the days of American dollars flowing to China were over. Because President Donald Trump didn't like this huge trade deficit, he decided to place tariffs on various Chinese goods, effectively starting a trade war. The first round of sanctions targeted more than 1,300 Chinese products, worth around $50 to $60 billion in yearly revenue. Beijing retaliated by placing import tariffs on American goods, including agricultural products. These back-and-forth rounds of tariffs continued until the end of 2019. Ultimately, $362 billion worth of Chinese products faced increased import tariffs. China had placed sanctions on 1,717 items from the US, representing about one-third of all imported American goods. In the beginning of 2020, the US and China reached an agreement to stop the escalation. The US wouldn't increase tariffs if China bought $200 billion of additional American products, including $50 billion of agricultural goods. This deal didn't really succeed because China failed to meet the target by about 40%. Although the trade war slowed down due to the pandemic, it definitely didn't end. The Biden administration kept the import tariffs in place, and the results of this policy showed. Right now, the trade deficit with China is at its lowest point since 2010. Even though this is also related to the economic slowdown in China, the import tariffs definitely had an impact. In some areas, President Joe Biden has even escalated the trade war. Through export controls, he wants to destroy China's capability to make advanced chips. Looking into the future, there is no sign of the trade war slowing down. Joe Biden has called for the import tariffs on Chinese steel and aluminum to go from 7.5% to 22.5%. Just like his former rival, Trump, he is still advocating for perfectionist trade policies to preserve strategic industries. Still, if Trump wins the election, there will be even more escalations in the trade war. Trump has called for import tariffs of more than 60% on various Chinese imports, effectively killing China's competitiveness in the US market. Because of the looming dangers of this trade war, the CCP decided to use the North American Free Trade Zone to its advantage. First, we have to talk about China's involvement in the Mexican manufacturing industry. 40% of Mexico's GDP is in manufacturing, and a large share of its products are going to the United States. This is caused by the free trade zone within the US, according to the USMCA agreement. Goods produced in Mexico can be exported to the largest economy in the world without paying any import tariffs. Because it understands how strategic the country is, China has gotten itself a good position in Mexico's supply chain. It exports tons of electronic equipment, machinery, plastics, and metals to the country. In this way, it's indirectly making money from the US as the supplier of its leading manufacturer. But the Chinese involvement goes far deeper than that. Chinese companies are setting up shop in Mexico itself to produce goods for the United States market. The Hafusan Industrial Park in Nuevo León is the biggest example of this. Two Chinese investment funds developed the area just 200 kilometers south of Texas. The park now houses various Chinese-owned factories worth hundreds of millions of dollars, producing electronics, furniture, and gardening equipment. In general, Chinese investment into Mexico has been growing over the years, reaching a peak of over $400 million in 2021. And this could get even bigger in the future. Chinese corporate giants are also considering investing in Mexico, including the electric vehicle maker BYD. This is the largest EV company in the world, by the way, recently overtaking Tesla in cars sold. For many companies, including BYD, it makes a lot of sense to have a manufacturing plant in Mexico. Cars from Chinese-owned factories in Mexico still count as Mexican products, even though the profits go to China. Chinese cars face a 27.5% import tax in the US, while these technically Mexican cars only have a 2.5% tariff. Meanwhile, the EVs made in Mexico qualify for a $7,500 tax credit under the Inflation Reduction Act. Apart from the tariff and the tax incentives, the business fundamentals of moving to Mexico are also pretty good. Manufacturing wages in China have been increasing, as you can see on this chart, and Chinese manufacturers are facing growing labor shortages. According to one survey, 80% of them had shortages in the hundreds or the thousands. China's very own Ministry of Education said the country will be short 30 million factory workers by the next year. To make the move even more appealing, Mexico has slightly lower manufacturing wages than China and more stable salaries. There's also a reduction in transportation costs because the manufacturers move close to their target market. Still, we can be a little bit skeptical about the Chinese factories in Mexico. For example, they may have strong connections to Chinese supply lines. Although the products are labeled as made in Mexico, many of the assembled parts could be Chinese. What's even more important is that the profit goes into China's pockets. This means that China will be able to replace some of the income lost through the trade war. But we also have to take into account the geopolitical effects. Through huge investments in the Mexican economy, China is getting itself a lot of influence in the country. This dashes the hopes of an independent North American economy, and it strains the ties between Mexico and the US. Still, involvement in the Mexican manufacturing industry is not the only way to circumvent the trade war tariffs. To understand this, we have to look at the e-commerce giants Temu and Shein. Their business model is pretty simple. Sell just about everything at incredibly low prices. Temu in particular has been pretty successful. For months, it was the most downloaded app on both the App Store and the Google Play Store in the United States. The company even got itself a Super Bowl advertisement with the slogan, "Shop like a billionaire." But there's something shady about these Chinese e-commerce businesses. They use a loophole in the US tax code called the de minimis rule. Imports under a certain value don't have to pay duties. Back in 2015, the price limit for this tax exemption was raised from $200 to $800. This was originally supposed to save a lot of hassle for customs officials and people crossing the border. You don't have to fill out complicated forms for souvenirs or other small purchases. But for Temu and Shein, it's a different story. They use the de minimis rule for nearly all of their packages, which is a big deal. These two websites alone now contribute to nearly a third of all small packages coming into the US. In total, the de minimis tax exemption applies to more than 75% of packages coming to the US. The law was written before the rise of e-commerce, so lawmakers couldn't really have seen this coming. But the effects of it are dramatic. Because Chinese e-commerce stores don't have to pay import taxes, they can easily outcompete US businesses. Apart from having a negative effect on American businesses and jobs, this is also hurting Washington's tax and trade policies. The lost import tax revenue ranges in the billions of dollars. And because online web shops are now a multi-trillion-dollar industry, This also has an effect on the US-China trade balance. But the consequences of the loophole go beyond just Temu and Shein. Warehouses are now being built in Mexico and Canada to take advantage of the de minimis regulation. They're basically fulfillment centers for companies selling in the US. Certain retailers need to import Chinese products in bulk, which is a big problem because of the hefty tariffs. Warehouses in the border towns on the northern or southern border can be the solution. The containers can be processed at low tariff rates in Mexico or Canadian ports, like the Port of Ensenada or the Port of Vancouver. Then the companies ship individual packages to their customers across the border using the de minimis tax exemption. This does come with the downside of longer delivery time in some states, but in a lot of product categories, the benefits outweigh the downsides. Keep in mind that these products don't fall under the usual duty-free access in the USMCA area. Because the products are made entirely in China, Canadian or Mexican importers would have to pay taxes if the price was above $800. But that's the trick. Because this scheme is so effective, there's a lot of investment going into this. For example, the logistics and shipping company Maersk has recently built a new factory in Tijuana. The city is located just 20 miles from San Diego, about 32 kilometers. In its press statement, the company said that it could use this for Section 321 shipment-type operations, aka tariff evasion. Amazon did the same thing, building a fulfillment center in the same border town. China is the biggest beneficiary of this because it gives it a lifeline to keep selling products to the US. These border town warehouses are one of the explanations for the flourishing China-Mexico trade. And to some extent, this is also happening on the US-Canada border. It isn't as obvious as Chinese goods going through Mexico, since Canada's imports from China have only grown slightly. As you can see on this chart, Canada's imports of Chinese products increased with about $10 billion over the last 4 years. Although it's relatively small, a part of this $10 billion consists of Chinese products going through Canadian fulfillment centers. One logistics company in Toronto is very open about this. When the trade war began, it advertised itself as an intermediary between Chinese manufacturers and US consumers. Nevertheless, the tactics for circumventing trade war taxes might disappear just as fast as they've come. US government officials are increasingly wary of Chinese investments in Mexico, and the potential EV plants of BYD will not go unnoticed. The current administration has already expressed concern about Chinese car makers entering the Mexican economy, and it might introduce policies to combat them. In the scenario that Trump gets reelected, these sanctions are coming there for sure. Trump has said he will impose a 100% tariff on EVs made in Mexico by Chinese companies if he gets elected. Meanwhile, Washington is putting pressure on Mexico and Canada to produce higher import taxes on Chinese goods. Recently, some senior members of President Biden's administration went to Mexico in order to discuss these issues. And they were pretty successful. Soon after, Mexico announced tariff hikes on more than 500 kinds of imported Chinese products. The new rates sit between 5 and 50%, affecting around 90% of all the Chinese goods going to Mexico. Because the United States is still the most influential country in Mexico, the Mexican government likely had no choice but to listen to its demands. And the most deadly blow to China's tariff invasions might be yet to come. Several US lawmakers are calling for an end of the current de minimis regulations. Together with a coalition of labor unions and manufacturing groups, they're pushing a bill to reform the import tax system. One idea is to vary the de minimis threshold, based on where the product originates from. The bill could get bipartisan support because many of the issues at hand are important to both sides. For one, the current tax exemptions are hurting the trade balance with China. On top of that, many Chinese products are fundamentally uncompetitive. This is especially true in the textile industry. China is flooding the US with heavily subsidized textile products, made with the forced labor of the Uyghurs in Xinjiang. Because they can sell these uncompetitive products without paying import duties, US businesses are at a huge disadvantage. This has terrible effects. In the span of just 5 months, the American textile industry lost 10 manufacturing plants. Another blatantly obvious issue with the de minimis rule is the amount of packages entering the US unchecked. Most packages under $800 are not checked by custom officials. That's why 90% of all illegal goods, including narcotics, enter the US in this way. With the alleged Chinese involvement in the fentanyl crisis, this is a huge problem. All the more reason to scrap this legislation. So, the US government has the tools to stop the Chinese tariff evasions. This is very important, both for the trade war but also for the wider geopolitical picture. In order to keep the free trade zone with Mexico and Canada, Washington needs to limit the Chinese goods flowing into these countries. This is the only way to have an independent North American economy, which is a very strategic asset. The free trade zone stems back to 1994, when the three countries cut out import and export tariffs to stimulate trade. In this regard, it was very successful. Trade between the United States and Mexico increased almost tenfold, from $81 billion in 1993 to $798 billion in 2023. U.S. trade with Canada also grew significantly, more than tripling from $211 billion to $774 billion over the same time period. The free trade zone did get a lot of criticism from Donald Trump because of the negative impacts on U.S. industries and jobs. This is because the United States has a trade deficit with both Mexico and Canada, which means that the U.S. market gets flooded with foreign goods. In 2022, this trade deficit was $53.5 billion with Canada and $130.5 billion with Mexico. Still, there's one big advantage to the economic ties with these neighbors. To understand this, we have to look at the drastic changes in the geopolitical landscape. The Pax Americana, which lay the basis for global trade, has been replaced by a multipolar world order. Because of Chinese trade, the US isn't the undisputed leader of the world anymore, both economically and geopolitically. The economic implications of this new world order are huge. For decades, the United States had safeguarded global trade. But if the world order turns multipolar, the downsides of global trade could outweigh the benefits. Washington can't guarantee stability anymore, which means that global trade routes can be disrupted by conflicts. In turn, many countries want to limit their economic dependencies on other nations. But there's one exception to this rule: regional allies. While Washington may lose its leadership role in the Middle East or East Asia, it can definitely keep it in North America. This is why economic ties with Mexico or Canada are beneficial, even in a multipolar world. And Mexico and Canada can replace many of the older trade partners that the United States has. Mexico has relatively cheap labor, and it's a huge sales market, something that US businesses can benefit from. Canada is already the biggest energy supplier to the US, accounting for 52% of total petroleum imports. This could last a while, since the country has the third largest estimated oil reserves, only behind Venezuela and Saudi Arabia. On top of that, Canada also has a lot of other natural resources like minerals and metals. Washington's neighbors have a lot to offer, which is why the region is worth protecting from Chinese influence. To sum it all up, China tried to manipulate the free trade zone and other legal loopholes to circumvent US tariffs. With the China-Mexico trade route flourishing, as well as the rise of Temu and Shein, this seems to be working. But the cracks, they're already showing. With new pieces of legislation and diplomatic action, Washington is trying to stop China's evasion tactics. Hopefully, this will secure the trade balance and strengthen the North American economy.